busy event. Projecting to have close to 1,500 people logging in to maybe 2,000 over the course of the day. We have 5 great speakers, actually 6, I'm sorry, 6 great speakers that are going to be speaking over the course of the day. Because it's going to be a very big event, they are going to be limited only to less than 45 minutes to 50 minutes to talk. They'll try to answer as many questions as they can as we're talking, so please be patient if your question doesn't get answered. They will be giving you some information regarding about how to find out more about them and contact them individually or their company. So I don't want to take too much time away from it. I know Price Headley, a very, very good friend of mine. Price has obviously, I've met Price over the years, very big in options and futures. Good friend down in Kentucky. I met Price not too long ago at the Cyber Expo. And, you know, just to let you all know, here at CyberTrade University, we do a lot of education, but the thing is, there are people that are very good at what they do. And, you know, once again, we're very happy to have Price to be here and educate you guys a little bit more about the options, about the Forex, about futures, and how these things work. Because, once again, he has a very, very good reputation. And the great thing, and one thing I like about Price Headley, is he's been around as long as I have. I've been doing this for 20 years, and I know Price Headley's been around just as long as I have with Big Trend. So, without further ado, I want to pass the microphone to Price Headley. Price, the stage is all yours.
Well, thank you, Fausto, and good morning, everybody. As Fausto said, it's a power-packed lineup throughout the day, a phenomenal speaker list. So you're going to want to stay tuned over the coming 6 hours or so because you've got just tremendous content coming your way. You'll probably be a little information overloaded by the time it's done, but the bottom line is you need to focus on what you need to work on. I'm going to share with you today my top trading strategies over my now 25 years of trading experience. I got started trading in 1990. And, you know, made some of those early beginner mistakes. So I'll share with you some of the lessons learned. And that's what we're about here is education today. Ultimately, then you want to get well educated, and you're in the right place today with all the great speakers. Then it's about getting more fine-tuned. So a big part of what we teach here at Big Trends is kind of, A, getting pointed in the right direction towards the target through education, then starting to narrow your focus through exploration, and ultimately it's about execution. Once you know what you should be doing, are you consistently pulling the trigger? And it's that consistency that when I talk to the Big Trends coaching students, they're telling me that that's their #1 goal these days. It's about consistency. It's about building a solid plan that you know you can follow over time and help you manage your risk, better manage your trades. So we're going to share that with you today. I am going to be trying to answer questions as we go as relevant, but then I'm going to also try to leave a little room at the end for a little quick lightning round. And Pete Nigerian is going to follow me, and in his honor, I'm going to pop into the Trade Monster platform, give you my quick take on the markets based on some of the indicators I'm going to share with you today. And it all starts with having a really clear plan of action. You know, it's like the old Yogi Berra type of quote. If you don't have an idea where you're going, then any road will get you there. Well, we don't want you to follow this kind of meandering, getting swung by the waves and the volatility of the market. We want you to have a plan of action. I think if you have a plan of action, you know, you get your bright idea, your competitive advantage, or what we call your trading edge. If you have an edge against other market participants, then you're going to be seeking to take advantage of that edge over time. If you don't have an edge, then frankly, you probably shouldn't be trading until you develop that edge, okay? So for what you'll learn today from Big Trends, and I think from a lot of our other speakers throughout the day, you're going to see is a predominant focus on technical analysis. And, you know, it's because technical analysis gives you very objective information about what the market is doing. Not what you think it should be doing, what you believe it should be doing, but actually getting yourself in tune with actually what price action and volume are telling you about where the market really wants to go. Now, you know, technicals through candlesticks and other types of long-term patterns have been around for centuries, going back to the Far East and tracking rice markets and all kinds of other markets. Well, the bottom line, though, is that because of computers, you know, when I got started in trading fresh out of Duke University, you know, thought I knew it all, had a few things to learn early on, and always learning. You always want to be green and growing. But because of the technology that was just coming online and has continued to come online with the internet, you have more power at your fingertips with these phenomenal trading platforms than, you know, institutional investors had out at their fingertips when I got started, for sure. And frankly, that's really leveled the playing field. You can use the power of computers to really make sure you're on the right track and letting the technical analysis tell you what you should be doing at any point in time. So I'm going to share with you how we look at this. Now, we're coming into a news-driven season with earnings coming up here in a couple weeks. And bottom line is, I always want to remind you that the news itself is not as important in my view. News matters, but it's the reaction to the news that a technician should care about. How many times have you all seen it where you saw, quote unquote, great news for a stock that had, quote, blowout earnings, and the stock actually dropped on the news? Anybody ever seen that happen? You know, it's the old buy the rumor, sell the news. That's classic technical analysis. And so, you know, we want to be aware of what's going on in the news, but as a technician, you'll get a leg up if you follow whether the markets are telling you there's more opportunity in that good news or if that good news is actually a point of exhaustion for the markets. Now, you know, as a trader, whatever type of trader you are, and when Fausto asked that question getting started here, you know, a lot of you said swing traders, and a lot of you are option traders. That's my specialty, and it's really, I think, a tremendous area of opportunity, but it's also an area that a lot of option traders make the mistakes of overreacting based on fear and greed, you know, based on their emotional reactions. And you've probably felt this as well. You know, trading can sometimes seem like a lonely game. It's you against the screen and you against all the other market participants. You've got to have the right tools to allow you to be confident and to allow you to be able to take those emotions out of the process of when you buy and when you sell. That's a big breakthrough for a lot of you as traders. If you're just getting started, you're going to need to learn that it's not just about entry and exit points, but it's about managing your own internal trading psychology. Now, when we talk about technical analysis, and I'm going to be kind of going through this overview fairly quickly so we can get into the charts. I know that's where a lot of you want to spend some time. But, you know, you need to know that technical analysis, we're talking about some key assumptions. Why does a stock drop after great news? Because a lot of times that stock has, quote, discounted what was already expected. You know, if it was already expected to blow out earnings, or there were whispers coming out that it was going to have even bigger earnings than what the street was expecting, then you're going to see that stock typically rally in front of that news, and then it'll tend to sell on the news quite often. And so, you know, we believe that the most important fundamental is earnings. Earnings do matter. But you've got to watch how that stock reacts to the earnings. So the price action is going to be telling us, is that information already priced into the stock or not? Is that new information? Is it really a true surprise, or is it pretty much what was expected? And now, you know, as when I launched Big Trends back in '99, well, the point was that this price action occurs in patterns. These patterns repeat again and again and again. You know, I like to say that, the song may change, but the pattern remains the same. You know, that the idea here is that emotions and human beings have very specific reactions. When the market is going up, everybody wants to be a part of that big run to the upside, but not necessarily all at once. It's a gradual conversion of skeptics until everybody becomes a believer. And so you get a lot of people who want to be riding an uptrend, and so there's not a lot of natural sellers in an uptrend until that trend starts to end, once everybody's piled in later in the process. And so the belief here is that, that certainly there's going to be some differences in the patterns, and if the songs don't exactly repeat, they certainly rhyme. You know, these patterns will tend to have a lot of similarities, and that's what I'm going to share with you today, is some of the similarities I've seen again and again and again, including more recent examples, against some of the longer term examples we'll show you. But again, you've got to manage your emotions, manage your psychology, because what happens is that people hit emotional extremes. People get too fearful at the bottom, say they panic out at the exact wrong time, and then they also rush in typically too late, right near or at the market tops. So that's the nature of the markets. We need to understand that. We'll take a peek at one sentiment indicator, the CBOE Volatility Index, at the end when we look at some live charts. So let me just show you a quick example. This is a past chart of Las Vegas Sands, ticker symbol LVS, the casino operator. And a couple of the different indicators that we have on the chart here, the upper bands here, you'll see them in blue, are my acceleration bands. They're a little different than your classic Bollinger bands because the acceleration bands are geared to factor in the trend as well as the volatility. And so when we see something breaking out like Vegas Sands here, breaking out not just above the acceleration bands, but you also see it above, we'll look at the CCI indicator today, the Commodity Channel Index, as well as the percent oil. Larry Williams developed the percent range indicator on the bottom panel here, and we'll go into the Trade Monster platform here in a little bit and look at some live examples. But this just gives you a little backdrop. It doesn't have to be on any platform. You can pick up a lot of big trends indicators on a lot of the major platforms. But what we notice here is when we're starting to get that breakout, I don't buy as soon as I see that first what I call setup. What I look for is what I would consider to be the follow-through point. When you see follow-through, it's usually after you get that initial surge and say, okay, does it continue or does it stop? Because what I want to help you avoid is I want to help you avoid whipsaws, or what we call the fake outs, and rather trade the true breakouts in the trend. So that circle is where we confirmed that initial setup with a follow-through, with a close above that first original setup bar's high. So that was happening in early March in the past. Now, the bottom line is, from that point, you can see on this particular signal for Vegas Sands, how would I trail my stop? Well, one of the most popular tools that I found with my subscribers is my unique take on the %R indicator, percent range indicator developed by Larry Williams. Now, this involves a little bit of a shift in your thinking, because most of you, if I say the words overbought, okay, if something is overbought, does that imply that you should buy it or that you should sell it based on the traditional thinking? Traditionally, overbought, just by definition, the word sounds like it's too extended, right? That it sounds like it's going to come back down. But if it goes overbought and stays overbought, and I'll show you my definition of staying overbought here, that actually can be an extremely powerful uptrend. In fact, a lot of you are missing the biggest and best trends in the market because your psychology, your prior training won't allow you to see opportunities because you think overbought is bad. And so I've been trying to retrain people that it can be bad, but it can also be very good. So when it goes and breaks out above that overbought first bar's high, and my definition of overbought is if it moves the top 20% of readings on the %R. I use a scale from 0 to plus 100. You can also use a traditional Williams scale. The bottom line is that when it goes overbought and then it keeps going up, what does that tell you? It tells you that people are buying. In this case, institutions. You and I know, whether you're trading $10,000 or $10 million, you're still a small fish in the big pond of institutional money. Institutions drive the market. And let's face it, they can't get in all at once. So if they want to start accumulating, and maybe they already have been accumulating Las Vegas Sands to help it break out, but they have not finished off their position, they can't add and build their position all in one day. It's going to take time if you're a bigger institution to move into or out of a given stock. So this is why, in my opinion, trends tend to last and take some time to develop. Because when you get that first breakout, that's what we call the first overbought and first confirmed buy signal for Las Vegas Sands. Now, as it comes back into this area where it would be possibly coming under this oversold threshold, when I first started trading these, as I was still doing literally testing on thousands and thousands of past data points, what I got worried about is if %R came out below that overbought territory in this case, then I was thinking I should get out because it's not staying overbought. But one of the reasons I like %R, say, compared to your classic stochastic or RSI type of indicator, is it's a little more jagged. It's a little more prone to, giving you these quick little whips down, and those become what I call retests. So every time that it comes down under that overbought threshold, that low is where I'm going to tighten my stop. And it's almost like an escalator. Right in that escalator up here, you can see that it's getting multiple test points. Now, why are those test points important? They're not just important if you're already in a trend. If you're already in a trend, then great. You can keep tightening your stop. If it has a close underneath that bar's low, you're going to get out on any time frame. If you're a position trader, the daily chart's ideal. For you swing traders, hourly charts are really my sweet spot for about a 1 week, 3 to 5 day type of a hold. But what you can see is happening here is that every time it's coming in for one of these retests, every time it tests under that overbought threshold, you can see we keep just tightening along the way. So if you missed that initial breakout, how many times have you missed an initial breakout? You were looking at it. For some reason, you just couldn't pull the trigger, and then you see it racing up, and you say, oh, I'm a dummy. I missed out on that move. Therefore, I'm not going to trade it because it's just gone too far. And then you see it go even farther while you're sitting on the sidelines. Anybody ever had that experience? I think psychologically, we probably all have felt that pain of missing out at different points along the way. The beauty of the retest technique that I developed is that when you see a retest, you know that it's putting a trade on at a fairly low risk entry point within that existing trend. It's more of a market structure question. Now, you see that not all retests can hold. Eventually, a trend has to end. But you can see in this case, once it finally ends here, there's the last retest, and you can see it's about to end here a couple days after that. So you see it's giving your exit signal down here. So if you put it on every retest, you had about 4 good ones, and then the 5th one started to work and then stopped working. Okay, so if 4 out of 5 trades worked for me like that, I'd be very happy, and certainly the majority of these are tested to work. But we expect that you're going to get losing trades as well. The beauty of it is if you're wrong, you can get out quickly, especially if you use options like I do. You want to have a trigger point to get you out quickly if it's not working, so you minimize not just your price risk, but also your time risk. Now you can see it goes through kind of a dead zone here where we wouldn't be trading this thing. So I'll put a big circle in this period, where it's just kind of stuck in the mud there. Now you see it gave another %R signal in here, but notice what's different about that signal compared to the last one is we're not breaking outside of my acceleration bands. So that doesn't have the same kind of power. So what we're talking about here is how do we combine indicators to actually find the most powerful signals. So you can see this next setup here that happens in July. We actually get all of them lining up here that starts to break out above those bands. And you see we get one retest that comes in for a nice little low risk entry point right in there. So you could have picked that up. Typically, if it's retesting inside the bands, I'll put a target up to my bands as a first spot to lock in a partial profit on your position and then trail the stop on the rest. This one got a slight stop out on the rest, and then you see it quickly re-signaled on %R. And you could have built a partial position there, trade it to the band, but then where you see this thing really take off, after that last retest right here, you see what happens? It absolutely explodes. You get this massive parabolic kind of a move. And you see a lot of people are worried about trading those kind of moves. You often hear this term used as a bubble. That a bubble is implied in the media as a bad thing. Let's face it. I launched big trends in '99 on the heels of making a lot of money trading the tech bubble and the brokerage bubble, and a lot of those stocks are running up. And so the bottom line is that after being director of research at another options firm and saying, hey, this is an ideal kind of a situation to trade parabolic moves that are speeding up. Speed is what you want in options. Now, I've got a lot to share with you. Now, you can see when did this finally end. You can see that last retest was slightly taken out here, just under $49 there, and would have gotten you out. Never will get you out at the exact peak. That's why you take partial profits along the way. But you can see once it's telling you to hop out, then it's like, okay, it's either at risk or it's going to go sideways. You want to move on to greener pastures at that point. Now, back to this quick overview on the principles of technical analysis. Fundamentals are not as useful for active trading from the standpoint that the shorter term you go, the more momentum can be a big factor. So you'll see a lot of my emphasis is on growth stocks, both on the way up and, as you know, on a lot of these momentum stocks recently on the way down. You don't want to buy calls on a, quote, cheap stock fundamentally because you might wait a long time. And even if you don't get hurt, even if it just goes sideways, you have an opportunity cost on your capital. You want to be in the relatively best ideas along the way. Now, the bottom line is that technicals seem complex, but really you can boil it right back down to price action and volume. Where's the money flowing, in or out? So we're looking at that supply and demand to determine the existing state of the trend and where that trend is likely to head, knowing that the past tends to repeat or at least show a lot of similarities, and our job is just to find the patterns, to use that past patterns to find the new opportunities along the way. So as I mentioned, to enhance your consistency, if you're a trend trader looking to be more consistent in your trend trading, you're looking to minimize your whipsaws and stop outs. You're going to have some fake outs along the way. You can't get rid of all of them, but you can get rid of a number of them by being a little bit more patient in your method. And that is when you start to see a turn in your indicator, whatever that is, and for my, as you saw in my case, it's %R with my acceleration bands and then backed up by the commodity channel index. Bottom line is that first turn is not where I'm going to buy. That first initial breakout is what we call the setup. We want to then let the market, essentially the stock, prove it to us. I always say to the stock, okay, I see that you look like you want to move on that setup, but now prove to me that you want to confirm that move and go ahead and follow through. This can be psychologically hard if you're used to only buying stocks after they've gotten pummeled. You know, I think that's a mistake when you convert that strategy into an option strategy. You'll learn that you want to be on those trend moves that are starting to just continue to have higher highs and higher lows. So the confirmation is what I look for before I'm putting on the trade. And so the setup is kind of that early warning signal that, hey, get ready, you might have an opportunity here, but when I run my scans, that's more of like a yellow, like you'll go from red to yellow to now green once it confirms, and you want to avoid that temptation to rush into your trades. You want to get some proof in the market that you're on the right track. You know, the other way that you can do this is you can also gradually build your position by buying part of your position on that first breakout once it confirms, and then part of it on that next retest. So we'll show you some more examples of that. These best trends are showing you these same characteristics, and so our job is to find them again and again. So the old Research in Motion with now BlackBerry BBRY, you know, the parent company of BlackBerry, you know, it's been pummeled in recent times. It got a pop late this past week from like 9 to 9.5. Everybody was excited about that, but guess what? The real action happened when, as Apple and Samsung and these others were taking market share, the BlackBerry was getting pummeled. And you could see it on the price chart with a couple of sell signals, and the really big one, sometimes that first one, you know, may or may not be the big one. The key is to be consistent in your execution. That first signal, you see you're making a little bit of money, but by the time it gives you an exit, it's just slightly below on the exit where you got in. You're not going to really make any money on that first bear trade. It was starting to make a little bit of money, but the big money happened on this next breakdown. Now you can see this is a stock that's breaking to new lows. A lot of you have been trained that you shouldn't bet on a stock that's down in a, quote, oversold range going any lower. Look at what happened to the BlackBerry maker, and you can see that it followed through below that first gap down low the next day. So that's staying oversold here on the percent R. You see how it stays oversold through this entire window over the next really almost, 2.5 months. And you can see what happened to the stock. It goes from 45 down into the low 20s, cut in half, a 50% drop in the stock in less than a quarter. You know, that's phenomenal. And then you can see along the way that bounces where you get a test back just into that oversold line, especially on the second one here with a classic test. And we told people, okay, that's a classic bear retest. Now this one, you can see it wasn't really going against this, but it took a little bit of time to really get going from the upper 20s down into the low 20s. And even this final retest point here from about 27 in just a week went down from 27 to about 22.5. So, you know, that's a huge percentage move in just a few days. Now, when that finally ends, you see that last retest, you're going to get stopped out a couple of days later on that kind of surge through there. This is why, again, you want to take partial profits and then keep tightening your stops on the remainder of your position. But the point of this graphic is that these opportunities exist in both directions. Oversold, just like in the financial crisis, some of our best put trades ever were as these financials were going oversold, and then they just kept falling like a stone from Bear Stearns, which we had, Lehman Brothers, Fannie Mae, AIG, were all good to us. Even though the options were, quote, expensive, we were buying the more in-the-money options in those cases to kind of get rid of some of that volatility priced into those options and allowing ourselves to ride that downtrend. Now, there's a lot of tools you can use. At Big Trends, we use some portion of each of these, and we're not going to focus on all these today, but you know, you've started probably looking at key moving averages. You've probably heard of Bollinger Bands, and we use a little tweak on that. My acceleration bands are kind of another way to see the trends when they're really big and really speeding up. We're also talking today a little bit about CCI, the Commodity Channel Index, as well as the percent R, percent range indicator. These all go into my market timing. So you've got to know where the market's going. We'll take a look at the market here before we're done as well. So, you know, and part of what I would show you too is that, like Netflix, not all trades are going to be right. So, for example, with Netflix in the past, when it was breaking down, you saw we had a couple of sell signals, and you saw by the time they got stopped out, that one was about flat. So if you buy an option and a stock is flat, you're going to lose a little bit in a week, and especially on these high volatility stocks. The first goal there as an option trader is make sure you buy an in-the-money option to protect yourself a little bit. You know, as you get more advanced, you can do spreads and things to help offset some of your risk as well. You can see this next trade here, slight loser by the time it exits. So those first couple, if you're discouraged by that, you're going to end up missing the really big trend on the downside. So sometimes you got to be willing to take some small losses as long as you can just do it in a very limited way. And then the bottom line is you see when this thing broke down that third time here, starting to really go underneath all that prior support, Now you're headed to the races, and then there's a second close in a row below the acceleration band as well. Look where that stock was when that happened. It was over 150 bucks on its way. As it stays oversold, notice this would probably only get you a partial position because you would never get a retest on %R, but then it goes from 150 to 80 in about a month and a half. So that's the kind of opportunity. And Netflix recently has been pummeled here as well. It's been a great trader in both directions. So you want to trade these growth stocks once you know this growth-oriented methodology. Now, we want to talk options for a little bit, just for those of you who either know options or are starting to learn about options. You need to know terms like the Greeks. The Greeks are to show you some of the key components of what drives an options value. So a lot of times what I encourage people to start off with actually is really focus on high delta options. So delta means how much your option is going to change when you get a $1 change in the stock. So, if you've got a stock at $100 and you buy a 100 strike call, means it gives you a right to buy the stock at 100 bucks. It goes 100 to 101, and say you've got a delta of 50. That means that your option, say your option was trading at, say, $3, and you say, okay, it's at 100, it goes from 100 to 101. A 50 delta means that your option just went from 3 to 3.5. So for that 1% move in the stock, your option just went up, 13%. So that's where the leverage factor of options kicks in. Now, I don't usually recommend buying at-the-money options, but those are the more aggressive options. But they also have the greatest theta risk, which is time decay risk, how much your option will lose day to day if you bought it, and say it's showing a theta of minus 0.03. It means that every day going by, nothing else changing. The stock stays flat, volatility doesn't change. You're losing 3 cents a day in theta if you buy that particular option, in theory. So the thinking is, okay, we want to minimize our time decay. So my first strategy is to say buy more in the money to create more of a stock substitute position. I might buy a 95 strike call when the stock's at 100. I maybe have to pay, say, $7 for that, but 5 of those $7 are intrinsic value. I have a right to buy 95. It's already at 100. That gives me 5 points intrinsic, and so only 2 out of 7 points, or maybe 28%, would be time risk. Okay, now if you look at Vega, a lot of people focus on volatility changes. So if you have an option and then all of a sudden the volatility doubles, that option is probably going to about double if it's, say, at the money, all other things being equal. So the thinking is, okay, well, you want to buy cheap volatility, you want to sell expensive volatility. And generally that's true. It's just that in my experience, the trend factors are much more powerful. And then gamma is something for you aggressive traders that you want to potentially get more bang for your buck. You might look for options where the gamma shows you that the delta is going to go up very quickly. And so, if we looked at a chart of what gamma looks like, this is a little bit more advanced for those of you that want to be a little more aggressive. You can see that your highest gamma, what does gamma mean? It means that if you've got say, a last day before expiration here in red, and you've got a 50 strike call and the stock's right at 50 here. Well, guess what? That probably has a delta of about 50%, because it's saying, okay, if it moves up a point, though, it's going to have a delta that's approaching what the 43 gamma means. The delta, when the stock goes from 50 to 51, your call goes from a delta of 50 to about 93. So it picks up like 43 deltas and going now at 51, saying, okay, where's it going from 51? So it's what that next point delta is telling you it's going to be. So you say, wow, that's incredible leverage. Yes, the problem is it works both ways. You can see that it also drops very hard. If you go down, even a point here, you can see that you're losing as much as you're gaining. So that's why timing is everything. This chart on the left just shows you as you get closer to expiration for your at-the-money option here in blue, picks up the most gamma, and as you go further out, you can actually see that you're peaking out in gamma for a longer term out-of-the-money option out several months, okay? So just a couple ways to visualize the impact of gamma. Now, we have a number of different recommendation programs at Big Trends that will call out specific new trading signals to buy or to sell, buy calls or puts, or even to do credit spreads and other techniques. But the bottom line here is that what we'll teach you over time is it's about whatever strategy you're using, you've got to come up with a focus list. So for our option chart strategy, we're looking at a little over 100 stocks now, but still there's probably 3,000 plus optionable stocks, right? There's There's more like 3,500 now. There's 500 plus optional ETFs. You got to pick your spots on which ones show you your best opportunities. So we look for these outlier trends in OptionShark with the more high gamma approach. And, you know, a lot of you are probably familiar with the classic statistical distribution curve, which just shows you that if you were looking at a classic standard deviation band, that's going to cover you in a wide range of prices here. You're going to see that if you're starting at a current price, it's saying that about 95% of the time, you'll see the stock trade within those bands of probability. Now, that's the case, but guess what? When the outliers happen, the black swans, as Nassim Taleb would talk about in his book, Black Swans, those outliers, like the financial crisis, like the booms and busts we've seen in techs, in gold, and oil, and in housing, boom and bust. Those outliers are where the biggest money was made, okay, in the shortest amount of time, in the most unexpected fashions, you know, in terms of how fast they move. And so we look for these outliers, like with acceleration bands, same principle, looking for that rare tail. And you say, well, why would you look for such a minority of cases? Well, because that's where the biggest opportunity is, and you can use the power of technology to go find these super strong outlier moves. Now, a big part of what we also look at big trends is not just the stock chart. I also like to look at an option chart. You say, why would you look at an option chart? It's just a derivative of the stock, isn't it? Shouldn't it look the same? Actually, it looks quite different a lot of the time. Why? Because an option is priced not just based on the stock price, it's based because of how much time is left before expiration. As you all know, an option is a time-limited asset. And then volatility, the more volatility is priced into that option, the richer that option gets, which makes that option go all over the place based on volatility changes as well as stock price changes. So that option chart will look quite different from the stock chart. Now, if the stock stays flat, your option, if you buy an at-the-money or out-of-the-money option, is totally at risk, 100%. So at-the-money and out-of-the-money, ATM and OTM options is where a lot of people play. I don't recommend that. I actually say you should actually cross those out. I would actually say don't trade at-the-money or out-of-the-money if you want to be more risk managed. I would recommend that you trade in-the-money options. Now, in-the-money, as we said, means that you're looking for, you know, something that's got a good intrinsic value already. So like the example I showed earlier, we're talking about stock at 100. Don't buy the 100 call. Consider the 95 call. Yes, it's going to cost you more. You're not going to get as many contracts for the same dollars invested, but that's not the name of the game. The name of the game is how much risk versus reward you're taking. If you buy an at-the-money or out-of-the-money, it doesn't move. You're taking 100% risk if you buy that option. If you buy the in-the-money, in that example I showed earlier, 5 out of 7 points intrinsic, buy the 95 call, stock's at 100, it doesn't move. You've only lost 2 out of those 7 points. You've kept your risk at about a quarter of your investment rather than 100%. That really dramatically changes your risk reward. So, you know, when we go in and we look at a lot of past examples, like here's Goldman Sachs. You can see Goldman Sachs. A part of what I teach is don't just look at the daily chart. You see the daily on the right here? This is Goldman breaking out on percent R right before the financial crisis, or not the financial crisis, before the fiscal cliff worries were kicking in. Goldman was already giving us a buy signal, and it was even giving us a little retest right at the end of 2012 as a prior example. And then as it kicked off in early 13, then our hourly chart, for you swing traders out there, the hourly charts where we like to focus, we're going to show you some current examples here in just a minute. The hourly chart was breaking out the start of the day on the 4th. There's your breakout happening there. And then look, the start of the day on the 4th on the 15-minute chart. For you quick traders, if you're looking for a day trade or 1 or 2 day trades, 15-minute chart. Catch that window, it breaks out, has that retest right after the breakout there, and then holds that support and then takes off the rest of the day. That's what you're looking for as a quick trader, is a big trend even on an intraday basis. So big trends don't just apply to long-term time frames, they apply to short-term time frames. And so it's all about relativity of finding those trends as they start to really make those unusual moves. So we were recommending a Jan in the money 125 call. As I said before, you know, this was an option that was about 6 points in the money, and we bought the option for about $7. You can see that it raced just even that day towards 10, then ended up going on towards about 13. We were out of the rest of it here at about 12. You know, just some of our indicators were telling us it was a little overbought, not in a true sense at that point. And bottom line was it was time to start locking that down. And in retrospect, while it did pull back a little bit, it ended up going even higher eventually. That's the power of these big trends. When they get going, they become almost self-fulfilling. Now, a big part of what we believe you've got to start with is the right foundation via education. If you haven't traded for a while, maybe some of these concepts seem like I'm going too fast. And obviously, I'm trying to pack in 20 plus years of experience into an hour. It's a bit challenging, but I want to remind you that if you want to continue your education on how to properly trade and find these big trends and know how to trade them, you can learn my top trading systems, know exactly when to get in and get out, and learn these tools a lot more clearly. Tools like %R, Acceleration Band, CCI, that you can find on platforms like Trade Monster and a number of others. We're going to show you some examples of that before we're done with the final lightning round. But you just want to go to that page here that we've set up for you because it's a ridiculous special. You're getting 3 DVD courses that I created that list price over $200. You're getting them for a total price all in with free shipping in the U.S. of just $49 for literally 5 hours of content. So you're going to want to check that out before we're done here. And if you have to, for any reason, step out briefly, I'm going to pop that in, and we're going to keep going on the education because I've got so much more to share with you. But I just want to make sure you don't miss out on a tremendous opportunity to really learn a lot of my trade secrets through our bigtrends.com/trade secrets special. All 3 of those courses for just $49. We'll finish off with that later. But it really comes back to making good buy and sell decisions and not overreacting at the wrong times. Now, with any given technology, you want to have the ability to test it. All my stuff is tested across a lot of different platforms, across years and years and oftentimes decades of data, as much data points as we can get on any stock or any market to go back and look at it and say, okay, does this system work? Frankly, I've been through hundreds, if not thousands, of different ideas that sounded good on the surface and didn't work. I'm really giving you the best of what I've learned over the last 25 years. And then we even have these through different platforms where you can get them as toolkits. You can run your scans. So we'll run a scan. You go back and look at Apple over, say, 20 years of data, and you say, okay, how did Apple perform on that system? And so you start to look as a trend trader. What I think you have to learn is that as a trend trader, you're not going to be necessarily shooting for massive win percentages in terms of, you're not going to necessarily win 80 to 90% of the time, especially if you're buying options or even buying the stock in this example. But you can see in this example that you made a fortune even with a 44% win rate on your long trade. Obviously, with Apple over the prior decade, for the most part, besides last year, you wouldn't have wanted to be short very much with Apple, right? And this system obviously had a lot more opportunities on the buy side than the sell side. But it shows you that this is something that a lot of traders miss, is that you don't have to have a massive win percentage. If you can have profit factors of 3 to 1 or more, if you're making 3 times what you're losing, you have the opportunity to keep your risk down and then let the trade run when you're right. That's a big thing that a lot of you need to learn, is how to let at least part of your trade run better. So that's part of what you'll learn through the DVDs and through this training here. Definitely watch it again because you'll see it through the lightning round here. I always want to know where the markets are potentially headed. S&P, gold, also we'll talk NASDAQ today. The bond market, oil is important, and then even the dollar, looking at currencies here. So, you want to be aware of those. I talk about a lot of the key ETFs as well as individual stocks. You learn my best technical indicators. And frankly, you don't always want to consider an option buy is not necessarily always your best option strategy. It may offer you the most potential to grow your portfolio, but bottom line is that, any time that you're looking at a trend, if it's too slow of a trend, I know a lot of you have bought calls on a stock that you ended up seeing being right on the stock and still losing money in your calls, and that probably wasn't the best option strategy if it was moving too slowly. And we're big on allowing our students to follow up with us and say, hey, am I getting this? Am I understanding it? If you put out an example, you can get feedback from us as a DVD buyer about making sure you're understanding the material. Now, we do have earnings season coming up very, very soon. Alcoa kicks off the earnings season, I believe it's April the 8th. And so the aluminum company, and the bottom line is that, of course, earnings will cause big jumps in what we call implied volatility. So as you look at your calendar, you say, well, we've got this volatility surge is going to come in these positions. And we're going to look at the volatility VIX index here in just a few. And bottom line is that you've got to make sure you're trading the right option. Frankly, I don't tend to advocate that you just jump right in the day before earnings and try to buy options, because that can be very costly. Those earnings cause a big spike in the pricing of those options. But what will also happen is that if you see an earnings reaction, you think, oh, I've missed it, it just gapped up on the earnings. A lot of times that can be a catalyst for future trends. So if you get a Facebook or, and a Google or any of these names, they gap up and then they keep going a lot of times after that. Now, the only time that you might want to hold an option into an earnings report is if you can get in early enough that you can take your part of your money, at least your risk capital, back off the table before that earnings report's hit. So, if you were doubling your position in front of earnings, you could take half off and keep half as a free ride, free trade. If you had a 50% gain, you could take about 2/3 of your position off. So if you had like 3 contracts on, you could take 2 of them off, hold one, and still get your risk capital back. So that's a sensible way to trade into earnings. We all know that earnings will tend to happen in quarterly cycles about 4 times a year. That volatility will tend to get juiced into those premiums. And the bottom line is that it can help you a lot, but you have to know how to manage it. You just don't want to overpay. And we don't want to just gamble. We don't want to do coin flips. We want to have strategies where we have an edge. And so we're all about finding those edges at big trends. And so do you sell premium in front of it? You don't just blindly sell premium either, because let's face it, there can be big gaps, and you want to make sure that, if you're selling premium, that you have a fairly stable market. So I tend to encourage people to, if you want to increase your consistency, you're probably better off to trade well enough in front of earnings to get in and out before the event risk. The same applies to jobs data, like next Friday's jobs data will be due. You want to be aware of that. Now, as I showed you before, we want to leverage technical analysis by looking at the multiple time frame approach, because we can really benefit from, if we get the short term, the day traders trading with us, the swing traders trading with us, and the position traders, and even long-term investors on our side, we're going to line up the odds of multiple rivers of time flowing in our same direction. That makes for a more powerful trend. If you have things flowing against each other, then you're going to find that you get a lot of chop and churn. We don't want that chop and churn. We want to get directional trends. So with the Trade Secrets package, you'll benefit from all that I have to share with you across 5 hours of content, learning my favorite systems, and really starting to educate yourself on the right way to trade truly overbought or oversold markets. So that's at that Trade Secrets link. And you'll learn so many different indicators from us at Big Trends over time. In the DVDs package special today, we'll put one indicator acceleration bands in particular focus on one of the DVDs, and then you'll see more about %R in another. So you're starting to learn the tools, as well as a lot of the psychology that goes into making sure you can follow those trends. And from learning the indicators, then you figure out, okay, based on the indicator, where the market or stock is likely to go, what is the next most logical strategy, both on how do we get in on a breakout trade, or how do we find those retests to find, in my opinion, lower risk entries, where if you're wrong, you can get out quickly and manage the risk, but if you're right, you can get some wonderful re-entry spots within an existing trend. And this applies whether you're a day trader, swing trader, or position trader. Market timing is important. I don't want to own the best stock in a down market. I want to own, sometimes those really good performers when the market starts going down. You've seen it recently. They start getting slammed. So we want to manage that very, very carefully. Now, a big part of what I do is I teach my students how to scan for the market. So if you're feeling any kind of information overload, a big part of what we teach here at Big Trends is how you can scan the markets and find better trades. So I'm going to share that with you here in just a moment and share with you kind of how I walk through the charts, find the new opportunities, and then figure out based on these systems where we have a new buy, a new retest, a new sell. And then saying, okay, from that, how do we find the right option strategy? So what's the best option strategy given the power of that trend or the non-power of that trend? And so, with all these key pieces, the reason trading is hard is you don't just have to master one thing. Trading takes work. Anybody that tells you it's easy is basically, shortchanging you. You need to know, and that's why you're here today, to learn a lot of different things from a lot of great speakers that are very experienced as traders in the markets. And so you've got to know these key pieces. So you got to know the market timing component, and the mutual funds don't want you to care about market timing because they want you to keep your money with them. But the bottom line is that, you know, it always pays to avoid big down cycles, or frankly, now you can learn how to profit from down cycles as well as up cycles. So the technical indicators will help you with that. Then you learn how to manage your trading psychology. A big part of that is knowing how to allocate your capital through the proper position sizing and money management. And then it's an option strategy should come as you know these other pieces. You shouldn't just try to learn options without understanding how to manage these other components, including yourself, because as you learn all those things, you'll know what's best for your trading style, for what time you have available. Be realistic. If you're working a day job, you shouldn't be day trading, you know, unless that is your day job. You know, the bottom line is that, you know, you might be able to look at a chart every hour, or you might only be able to look at it once a day. That's okay. The daily chart can be very effective for people to take a position trade over the next week to 4 weeks. So that can certainly work in your favor. Now, you know, and we'll come back and remind you on trade secrets, but I want to share with you real quickly my desktop. And we're going to take a peek here at, you know, how I go through and look at these kind of opportunities. So let me share quickly my trading scans, and I want to make sure this works. So let's see here. Okay, so we're sharing right now, and just tell me that you can see this. This is a trading scan board. You got Visa, GILD, Sohu at the top. But tell me that you can see that, and make sure that I'm not broadcasting into the ether sphere here. Yes, okay, we can see that. Thank you, Steve. Okay, so bottom line here is what I do, this is a daily interval, and I use multiple platforms. I'm going to share with you the Trade Monster charts here in a minute, but I use also TradeStation and a variety of others. So the bottom line is, you know, if I'm looking at %R signals along with, say, the CCI, these are indicators I've created for our Big Trend students, and you can get them as a toolkit for any given platform that we have them on. And I can sort by what's really strong or what's really weak. So I want to look at the CCI indicator, which is the Commodity Channel Index, and I go through about 150 key stocks here. So you can see the ones that are strongest here on that chart include one that, you know, I was mentioning to my students here at the end of the week, First Solar. Even though it's down a little bit on Friday, a lot of the momentum stocks were down. First Solar came right back in for what we call a retest. Red signals a potential retest to me. That's on the %R scan here. Green signals a new buy. So the OIH, in comparison, the ETF on oil, was giving us a new buy signal at the end of the day on Friday yesterday. So that's signaling that it went above 80 and then it closed even above that Thursday high and said buy it on Friday. Oil was very strong. You can see another one that fits that with XLE. This is the oil ETF that tracks the energy sector. So oil is strong. You can even see down here another one, Suncor, SU. Also Caterpillar was also giving a signal in green here as well. So green signals a breakout, red signals a potential retest. If we flip it around on the bear side, you say, okay, these are ones that were particularly weak on CCI, and if we go look at which ones are going green here on the bear side, there's one, Gilead. Now, we're going to verify. I'm not saying you should go out and buy puts on it. We're going to take a look at these charts here and just verify it. Whole Foods Market, WFM, going green. Whereas we got a bear retest on Twitter, and we actually mentioned that to our students here at TWTR. We made money on that earlier in the week. So we're building a quick little watch list that we can then say, okay, you know, with this information, we can then go in here and look at, okay, what's telling us that we have an opportunity here. So what I'm going to do now is I'm going to share with you, if you go in and look at the Trade Monster platform, and you should see, like, let's just pull up an example here with Twitter for starters. Okay, so Twitter, we're looking here at %R, and then we're looking at the acceleration bands. You should be seeing TWTR. If you're not, let me know. And so what we had happen, this is the daily chart. You remember when Twitter IPO'd, it IPO'd at opened at 45.10 back on November 7th. Here on the Trade Monster platform, they do a nice job of just showing you, okay, you know, those prices when you just hover over those candles, okay? And it traded that day to 50.09, and then it closed back at 44.90. So guess what? 45 and 50, pretty big levels initially. And you can see when you just draw a clean line across 50, that, gee, that was kind of an important level, right? We broke out above it. We were breaking the acceleration bands. We were really surging, you know, had the bullish opportunities there. And then you can see as that trend changed, we came back down to 50, but didn't follow through. Notice it went oversold. We didn't follow through. So that's not a confirmed sell there. That's just a fake out. We wouldn't be in a bear trade there. We'd be waiting. But you see what happened here a couple weeks ago. Back on March 13th, we started to go over, March 14th actually, we started to go oversold here. And that low was the key low to watch, 51.80. And you can see that in the next day, next trading day, which was actually the following Tuesday because of the President's Day holiday there, I guess. Or no, that was St. Patrick's Day, and then the Tuesday was right after St. Patty's Day. Bottom line is it then confirmed. So it didn't confirm the first day after that setup at 51.80. It hung in there at the close, but then the next day it did. So you can see percent R is going to tend to give you a signal before the acceleration bands. That's one of the reasons I added it into the mix. And what's happened here is we managed to catch this swing down here for about a 40% gain for our weekly options clients. Bought a weekly in-the-money 52 strike put back here as it was just breaking 50. We paid $290 for it, and we got out of the first piece at a 30% gain, the rest of it at a 50% gain. It went on to 100% gain. That's okay. You know, bottom line is we were out, and then it bounced. And now this bounce says that look at what happened here. This bounce into the high from yesterday is now at what we call a bear retest. So what that means is that yesterday's high is the key resistance going forward on a day-to-day closing basis. That means that 47.34 is the number. Now, don't overreact if on Monday it trades to $48 or wherever. It's saying that you wait for Monday's close, Tuesday's close, etc. You say, look, if we're looking at that and we're saying, okay, this is an opportunity for bears to bet that maybe it snaps back down to potentially test the lows, or maybe even worse, go down to the old lows near 40. Now, you can't, as a trader, ever get stuck. And remember, these are not specific recommendations. I'm just giving you some examples of how you want to think about trends and setups in trades, okay? But bottom line is that you can also, of course, look down at, say, shorter-term time frames. Say we're looking at the hourly chart. Let's just look at that over the last 10 days, actually. So with the hourly chart, like I told you, we were getting in here based on the hourly breakdown, and we'll even look at other tools like the commodity channel index here as well. So you see the hourly breakdown happening, and this thing just keeps on drifting down. How does that happen? Well, because remember, percent range is just looking back and saying, what's the range from low to high over the recent periods? And the bottom line is that when we look at that, you can see that, you know, we're looking back and saying, hey, about the last 4 days in this particular time frame, we're saying this is picking up that it's got a low of the range right there. But look, it keeps making a lower and lower into the range. So it's just stretching to be hovering in the bottom few percentile because it keeps closing near the latest low of the range. You see it finally flipped and reversed on the hourly chart, came back into kind of the no man's land on the hourly. It's a little choppy there, but this is where you try to line up your time frames. We had the daily chart bearish and the hourly bearish. That was a particularly sweet trade when they're lining up that way. Okay, so that's an example on the bear side. And then I mentioned on the bull side, if we were, you know, closing in on, say, First Solar, you know, FSLR, and then we'll look at the energy example as well. You know, so First Solar, as an example, you know, let's look at a little more time frame there. You know, the solar stock's one of the hottest sectors here in the first quarter. Does that mean it will continue? Who knows? I mean, people always ask me, how do you know it's going to hold that retest? And my answer is, I don't. But what I know is if I'm wrong, I can get out quickly and usually fairly contain my risk. And bottom line is that if I'm right, I can catch some wonderful sweet spot reentry points. So you see in a couple of past surges for First Solar, when it goes overbought and follows through, for example, it went overbought, followed through back here in early October, and you see they came in for a retest right there, October 9th. And so then that low, October 8th actually, and it held that at the close, 41.53. It was below their intraday the next day. We call that a bend but not break, and then it closes back above there. That flushes a lot of stops, and then we keep running. You want to get a trade on into that little retest support because then you see where it actually goes parabolic over the next couple of weeks. Comes in for another retest right here. If you miss that move, chops around for a couple of days. That's why buying the in-the-money option is the more sensible strategy. And then it spikes in early November. So, you know, again, no guarantees here, but we are saying, look, the low from, what day was that? Let's zoom it in now. The low from a couple days ago, let's be specific, but again, just these are example purposes only. That low was 68.37. So the percent R methodology says if it closes underneath that in a future daily close, then the position trader is going to get stopped out. But if it holds, then essentially we're planning to try to trade it back towards the old highs, and it maybe even breaks to new highs. So that key low we're saying 68.37 is the number that we're watching, okay? So the bottom line is that when we focus on that, we know, okay, look at what happened. It traded below there on Thursday, but then it closed back above there. That's the bend but not break. It tries to it flushes some stops intraday, and then it hangs in by the close. And we did the same thing as we look into Friday, the low 68.38, but so it's just down in that same level, 68.37. The market has an amazing memory, better than yours or mine, I bet. Bottom line is we can stay with the technical analysis to keep our memory sharp. And so it closed above there, 68.64. But we're still using 68.37 as our stop, and we're going in the money. Now remember, you've got to check your earnings calendars and make sure you don't step in front of an earnings situation. If you're buying April options, well, in this case, First Solar has earnings in May, so you don't have a problem there. But just check your earnings calendars and be very careful about that. Now let's take a quick look at the markets before I'm done, and then I'll hand it back off to Fausto here in a couple minutes, so he'll keep it moving smoothly over to our next speaker, Pete Najarian of Trade Monster. And the bottom line is, okay, look at the S&P. Okay, we had a prior little uptrend going on %R. We'd broken out and confirmed on Valentine's Day. We love that signal for a while. Bottom line is it trended for a little bit, right on up here into early March, and we saw it came in for a retest here. That retest held just by the literally just by the slimmest of margins. Its low was 184.66, and the next day, that was a Friday, the 14th, it was below their intraday, and it closed smack dab on the number, 184.66. We would hold that trade at that point based on the %R rules, but we would say, okay, that's got to hold 184.66, and then it popped up into early St. Patty's Day and the day after. We came back in for another retest here about a week ago on the 21st, last Friday, and then you saw what happened this Monday. That low, the 21st, you can see it broken on Monday's close. It closed below there. So now you're out of that prior bull signal. Even if you bought it at that prior retest, you made a little bit of money. Not much, but a little. And then the bottom line is now it's in a no man's land. So now we would wait. We would say, okay, it's not really bullish or bearish. Does that mean you go rush out and do an iron condor? You could, I mean, but bottom line is here's my problem with selling premium right now. The VIX, I promise you to look at it, is very low. You know, it's hovering in the 13.5 to 14 range. It doesn't seem to want to go down much under 13.5 into the 14. You saw it was below their intraday on Friday morning, and then it came back and snapped back up above 14. This is kind of a caution to me when we're hovering near the oversold levels but not really trending on %R. It's a caution to me that VIX probably needs another pop up here on the band. My acceleration band shows 18 needs to be tagged again to have another fear spike like we had March 14th. If you bought March 14th, you made a little bit of money when it popped back up, like we said, on St. Patty's Day and the day after. The problem with this market right now is the NASDAQ. The NASDAQ is lagging. In fact, it's on a sell signal on the QQQs. We set up back here on the breakdown on the 26th on Tuesday, and it closed underneath that on, I'm sorry, that was Wednesday, and closed underneath it on Thursday, 86.87. So the Qs are in a bear signal. The only problem is we're at the lower acceleration band. We're above the longer-term moving average. We haven't broken the last swing low. So how effective can this signal be? I think it's going to be mildly effective, but not maybe the start of a bear market. We're still above the longer-term support lines. But here's the problem. If you go look at all the big momentum names real quickly, Netflix is broken, you know, Amazon, you know, right back at the 200-day, but, you know, not acting good. It's technically a sell signal, but right at the 200-day, so it's kind of crunch time. Google, same thing, you know, broken and below those acceleration bands and right back near some key 1100 support. So it's really crunch time. The NASDAQ has been, money's been shifting out of the NASDAQ. That usually means that portfolio managers are playing defense here in the last couple of weeks, and we'll see what happens as we head into earnings season. So right now, you'd have to say that even if you looked at, say, the Dow, one last index to look at, very choppy, but, you know, with the NASDAQ rotation, it's telling you that, okay, it's still a little bit day-to-day cautious, and we're not in an all-clear mode. If you're a quick trader, remember, you're trading, say, the NASDAQ on an intraday chart, you can switch your time frames here in Trade Monster, and you can say, look, hourly chart, you know, kind of nice little hourly trade on the downside there. The 15-minute was even better. If you go to, like, the last 3 days and just look at, say, a 15-minute time frame, caught that nice swing down. Look at that retest on the pop up. If you missed that first move down or you wanted to add to your position, you could do it there and catch that next pop on the downside. As of Friday, it was still trading ranges. Now, you know, my hour's about up here, so I want to kind of unshare my screen here and say, okay, let's come back to just quickly remind you how you can take advantage of this kind of training. Lessons I've learned over 25 years of trading that you can get compact into a 5-hour course. You go to bigtrends.com/trade secrets. Go to that page and you'll see you get 3 different DVDs shipped to you for free in the U.S. for just $49. If you're overseas, it's a nominal extra shipping charge, but basically it's a great value. Take advantage of it today, and you'll, I think, love what you learn from us at Big Trends. It's a starting point where we find a lot of our traders start there, and then they want to go on and learn a lot more. So, you know, you're constantly wanting to stay green and growing and educate yourself the right way to trade the trends. So go to bigtrends.com/trade secrets, and we'll go ahead and hand it back over to Fausto right now so he can introduce our next speaker.
All right, Price,